Are you tired of paying your landlord's mortgage with nothing to show for it? If you are currently renting, you are missing out on massive financial benefits of owning your own home. Stay tuned, because we're going to show you why owning your own home gives you financial and personal security that you can't get by renting. That's coming up next.
We're Glen and Kelly Nelson with Realty ONE Group West, and we recently asked a trusted mortgage advisor to explain the significant benefits that only come from owning your own home.
We recently sat down with Keith Murphy, a 25-year seasoned mortgage advisor with Essex Mortgage, to get an insider's view of all things home loan related. We created a series of videos to give you the inside scoop on the different types of lenders who make mortgage loans, the difference between a pre-approval and a pre-qualification, renting versus buying, and the importance of a great mortgage lender.
This is the third video in the series where we cover the benefits of home ownership. Besides protecting yourself from rent inflation while providing a roof over your head, the long-term return on investment of owning your home will build financial wealth.
Would you say is the number one or two benefit of buying and owning a home versus renting?
Great question. The first topic that comes to mind, and it's something I'm very passionate about because nobody's really talking about this. When you're renting, you're subject to rent inflation.
Sure.
Your landlord can increase your lease payment or your rent payment whenever they want, unless you're in a rent-controlled area or you're renting from family, which most people aren't. They're subject to seeing an increase in their rents. And in Southern California, right now, we have a housing shortage, not just for people that want to buy a house, but for people that want to rent a home. There's too many people coming out of college, moving out of their parents' basements. Based on the demographics in our country, there's a lot of people coming online that need housing right now, and all data and statistics point to the fact that it's not going to end anytime soon. In fact, they're predicting over the next 20 years that the demand on housing is going to be tenfold from what it is today. That's only going to increase rents. So this rent inflation factor is the number one reason I would say someone should consider and start mapping out a plan to buy. Why? Because when you own a home, if you get the right mortgage, which is a fixed rate mortgage, not an adjustable rate, but a fixed rate mortgage, your housing payment, your housing costs are now essentially capped. Yes, property taxes are going to go up. Thank God in California, at least, we have Proposition 13, which limits how much they can go up each year, which is equal to 2% of the previous year's tax dollar amount. So you're not going to see your taxes go up very much. And then the inflation factor on your homeowner's insurance. But if you're in a mortgage that's in a 30-year fixed, as an example, your housing is capped. So everybody else's rents go up, your housing is going to stay at one point. And it may seem like a lot today, but in 5 or 10 years when you look back, you're going to say, wow. I'll give you an example. When my family relocated here from Seattle, which is 17 years ago, we thought it would be prudent to maybe rent for the first few years and feel out the market before we bought. But because I had a real estate background moving down here, I knew that was a mistake. So I went ahead and bought a home. We're still living in the same property that we bought 17 years ago. But I remember it like it was yesterday. We could have rented the exact same home for about $1,100 to $1,200 a month, but my mortgage payment was $1,600. I remember thinking, Keith, why do you want to put your family in this financial position when you're stretching $500, $600 more per month? Just rent for a couple of years. But I knew the math, and I knew that long term, which is how you want to think about this investment, is long term, the best investment move would be just to buy. So we did. Fast forward 17 years today. Our home is nearly paid off because we haven't pulled out the equity to buy stuff. Okay, we've been very prudent. Our mortgage payment then is now about $1,750 because it's gone up over the years with the taxes. We're still in the same fixed rate loan, but guess how much rents are now in our neighborhood?
Oh, I was going to say, to rent that house in your neighborhood would probably be $3,200?
$3,300 to $3,600 per month.
Right.
So there are families living on our block that were there renting when we moved in and are still living in the house renting. My mortgage payment's now down here, their housing costs are up here. If you look at someone's expenses,
Yes.
okay, and think of it like a pie chart, the largest slice of the pie is going to go to housing. You have your utilities, you have medical
Right.
costs, you have
Food.
groceries, food, clothing, what have you, like life. But tell me one of the slices of pie on that spectrum, other than housing, that you can put on lockdown and cap for the rest of your life.
Right.
There isn't one. Gas prices are going to go get up whether you like it or not. Food and energy, healthcare costs. Do you know when we first bought that house, our healthcare coverage for a family of 4 was under $1,000 a month. Today, the deductibles have increased, the annual minimums we have to meet have increased, and our monthly insurance is over $1,800 a month.
Wow.
So our insurance costs have almost doubled in 17 years. Rents used to be $1,100, $1,200 a month. They've now tripled over the last 17 years. Every single category except the housing keeps going up. And the scary part is, if you do some research, all those expenses are going up faster than people's salaries. Even though the government says inflation's at 3%, if you look at the fine print, they say that excludes food, housing, and energy costs.
And the bonus, as he said, is that his home is almost paid off. And I'll just estimate here that you probably paid $250,000 approximately.
$318,000, and today I could sell it for about $850,000. Year over year, it's kind of hard to gauge where you think housing prices might be. But if you look back over history, every decade they don't go down, they go up. The number 2 reason I would say is when you're writing a check to your landlord, there is no return on investment. Okay, but when you're writing the same check on a mortgage, a portion of those dollars are coming back to you. Here's how it kind of works. Today, mortgage rates are in the low 4% range for a 30-year fixed. So the very first payment that you make, it doesn't matter what the mortgage size is. It could be $100,000, $400,000, $600,000. The math works the same way. About 25% of the principal and interest portion, 25% of that portion goes to principal.
Right.
You're paying down your debt.
Yes.
The very first check you write, about 25% is going in your pocket on a piece of paper. Think of it like a profit and loss statement. You can't draw on it. You don't want to draw on it, but you're building equity because you're paying yourself every single month before anybody else in the form of debt reduction. So as you mentioned, as the housing prices are appreciating, the debt that you owe is also going down. So you're building equity 2 different ways.
Right.
On top of that, it's sort of layered into this analysis, but is the tax benefits.
Sure.
At the end of the year when you're renting, you can't add up all of the rents for the year, say $36,000 in rents, and take a deduction on your income.
Right.
But when you own a home, you can take the interest and the property taxes, and there are some laws now that cap the property tax end in California, but you can take all of the interest and up to $10,000 of your state income tax and property tax combined, up to $10,000 can be deducted from your income. When you start factoring in how much you save on California state income taxes and IRS federal income taxes, and you blend that savings in with your principal reduction, it cuts your mortgage cost or housing cost by about 35-40%.
Yes.
And so I would say that would be the number
That's
2 reason
great.
is every single month, financially speaking, you're getting a little bit further and further ahead. And as your salary's increasing and your housing payment's staying down here, more and more money is now left available to invest in other assets like
Right.
mutual funds and your 401k, etc.
Children's education.
Children's educations, yes.
Yes. So for me personally, I love the math. I got into banking because I wanted to understand the math of how money can help us make money and how we can invest in something that we think is an intangible, which is our loan and our self, but it turns into something that is going to benefit us long term. So to me, that's always been a real exciting part of it. Long term, what I see the benefits as a real estate agent for renting versus buying is I see the difference in how people feel when they get to get those house keys and they go in and they own that home now. They get to tell their daughter, you pick out a bedroom, this is yours, honey, and you can paint it whatever color you want. I love it when people feel empowered, and I think that home ownership is very empowering. You mentioned a fixed rate mortgage versus an adjustable mortgage. Would you say that there is ever a time when an adjustable rate mortgage may be beneficial for someone?
I would say might needs to be emphasized though. So to put something in perspective, we're fortunate enough, my team and I, we have 500 to 600 clients referred to us every year. And I would guesstimate that maybe 10 people in any given year might fit that box where we are living in California because we were transferred here with Microsoft as an example, and we are on a 3-year or 5-year employment contract, and we 100% will be relocating back to Seattle where we came from as an example when this Microsoft contract is up. And I'll question them and say, are you sure? What if they want to extend your contract? What if you end up liking it here so much that you don't want to leave? Will that be an issue for you if rates are higher in the future? And I get them thinking about it, and they'll usually say, you know what? The spread, the difference in payment between the adjustable rate, which is typically lower, and the fixed rate, which is typically higher, the spread or the savings isn't worth the risk. So I'd say most clients, when they think there's a circumstance that might warrant that savings, when they think about the risk factors, they don't do it. And I kind of champion that too. That lower interest rate and payment may sound good today, and it helps them maybe even buy more home, but the market can change, the interest rate market can change quite swiftly, and you don't want to be in a position where you can't afford your house payment anymore and you have to sell to get out from underneath it.
Be sure to watch our next video in this series, where you will learn what to look for in a great lender. For more information on the home buying process, be sure to get our free Things to Consider When Buying a Home. Just click the link in the description box.
Thank you for watching. Don't forget to subscribe to our channel, and we will see you next time.